When you see an ETF offering a 10% yield or higher, your first instinct might be excitement. Who wouldn't want to earn double-digit income every year without lifting a finger? But here's the thing. Behind those mouth-watering numbers, there's usually a catch, and that catch can mean the difference between building long-term wealth and slowly watching your portfolio drain away. So today we're breaking down the truth about high-yield dividend ETFs, the ones promising 10%, 12%, sometimes even 15% annual yields. We'll unpack how they work, where the money actually comes from, and why that income might not be as stable or even as real as it seems. By the end, you'll know exactly what separates a smart income strategy from a slow-motion disaster. Let's start with the basics. When you invest in an ETF, that yield number you see, say 11%, is calculated by dividing the fund's annualized distributions by its current share price. So if the fund paid $1.10 in dividends over the last year and the price is $10, that's an 11% yield. Sounds great, right? But here's the trick. If that ETF's share price keeps falling, the yield appears to rise even though you're not actually earning more. It's a mirage, a byproduct of declining asset value. This is where many investors get fooled. They see a high yield and assume it means high income. But sometimes what's really happening is that the ETF is just paying back your own capital, essentially giving you your money back while eroding its net asset value or NAV over time. Take the example of popular covered call ETFs like QYLD, RYLD, or XYLD. These funds generate income by selling call options on indexes like the NASDAQ 100, the Russell 2000, or the S&P 500. Each month, they collect premiums from those options and pass that money to investors as dividends. That's how they achieve such high yields, often between 10% and 12%. But here's the downside. When markets rise sharply, those call options cap the fund's upside potential. In simple terms, they trade long-term growth for short-term income. Let's unpack that. A covered call strategy works like this. The ETF owns a basket of stocks and sells call options on them. That means it agrees to sell those stocks at a predetermined price if they rise beyond a certain level. The buyer of the call option pays a premium upfront. That's where the income comes from. But in exchange, the ETF gives up most of its growth potential above that strike price. So if the NASDAQ surges 20%, QYLD only captures maybe 3% to 5% of that because it's locked into those options. Over the last decade, QYLD has paid consistent dividends, yes, but its share price has barely moved or even declined. Meanwhile, the NASDAQ 100 itself soared more than 250%. Your monthly dividends look strong, but your portfolio doesn't grow. And without growth, inflation eats away at your real income power, and that's where the warning lies. High yield isn't free. It's a trade-off between income now and growth later. If your ETF is constantly depleting its capital base to sustain payouts, you might end up with a shrinking portfolio even as those monthly deposits hit your account. Let's look at an example. Imagine you invest $100,000 into a 12% yield ETF that pays $1,000 per month. Sounds fantastic, $12,000 per year in passive income. But if that fund's NAV drops by 6% annually because of capital erosion or poor market performance, after 10 years, your $100,000 could be worth only around $54,000. You'd have received your income, sure, but you've also lost nearly half your principal. That's the trap of unsustainable yield. So what drives this erosion? For many of these funds, it's the way distributions are structured. In covered call ETFs, part of the income often comes from return of capital, or ROC, which is literally a payout of your own investment money. While ROC isn't automatically bad, it can be tax efficient, it becomes dangerous when it's used to mask poor performance. If you read the fine print of QYLD or RYLD's distributions, you'll often find a portion categorized as return of capital. It means the fund is paying investors by slowly selling itself. Other high-yield ETFs, particularly those investing in leveraged debt or emerging market bonds, amplify income using borrowed money. Leverage magnifies returns, but it also magnifies losses. When rates rise or markets drop, these ETFs can implode faster than investors expect. Here's something most investors don't realize. The way a fund distributes income matters almost as much as how much it distributes. When a covered call ETF sells options at, say, a 5% out of the money strike price, it's already predicting and limiting how much it expects the underlying index to grow that month. Over a full year, this subtle cap compounds into significant opportunity cost. If the market rallies 15% in a year, but your ETF caps out at 2%, you're giving up 13 percentage points of growth. Multiply that over a decade, and you're looking at a portfolio that's hundreds of thousands of dollars smaller than it could have been. This is especially critical during the early stages of a bull market. When the market's been sleeping, volatility is low, and option premiums shrink. That means the fund's yield drops just when you thought your income was locked in. JEPI and similar managed covered call funds experienced yield compression in 2023 to 2024 precisely because of this. Lower volatility meant smaller premiums, which meant lower payouts. Investors who relied on that 10% yield suddenly found themselves getting 6% or 7%. Now, does this mean all high-yield ETFs are bad? Not at all. But it does mean you need to understand what's under the hood, because not all income is created equal. Let's break down a few examples. QYLD pays monthly income from selling call options on the NASDAQ 100. It yields around 11%, but total return over 10 years is roughly half that of the NASDAQ itself. JEPI, the JP Morgan Equity Premium Income ETF, takes a more conservative approach. Like QYLD, it uses covered calls, but in a more active, risk-managed way. JEPI targets lower volatility stocks, think Microsoft, Johnson & Johnson, Procter & Gamble, and writes options selectively. The result? Around 8% yield with far better capital preservation. Its total return over the last few years has actually been competitive with the S&P 500, especially when you factor in dividends. And DEVO, the Amplify CWP Enhanced Dividend Income ETF, focuses on dividend stocks first and sells calls selectively, yielding around 5% to 6% while maintaining growth potential. The key difference? GPI and DEVO balance income with total return. QYLD prioritizes yield alone. That's the fundamental choice investors must make. Do you want the biggest possible paycheck today or the healthiest portfolio tomorrow? Let's say you're looking to live off dividends in retirement. A high-yield ETF might sound like the dream. Monthly payments covering your bills, predictable cash flow, no stock picking required. But unless that yield is sustainable, you're just liquidating your portfolio slowly. The best approach is balance. Combine moderate yield ETFs with reliable dividend growth funds so your income grows with inflation while your principal stays intact. For instance, a blended ETF portfolio might look like this: 40% VIG, Vanguard Dividend Appreciation ETF for dividend growth and stability, 30% GPI for consistent monthly income, 20% SCHD Schwab US Dividend Equity ETF for strong fundamentals and value exposure, 10% in bond ETFs like AGG or BND for ballast. That mix gives you a yield around 5% to 6%, not as flashy as 12%, but it's sustainable and backed by quality assets. Over 10 to 20 years, that's what builds true financial freedom. Here's a scenario that keeps retirement planners up at night. You retire with a portfolio of high-yield ETFs generating monthly income. Everything looks perfect until suddenly the market drops 30%. Your ETF's yield spikes because the share price plummeted. But here's the painful part. That income might be unsustainable going forward. The option premiums that funded those payouts depend on volatility staying elevated. Once volatility normalizes, so does your income. But you've already built your retirement budget around the higher payout. This is sequence of returns risk, and it's why relying solely on high-yield funds in early retirement is dangerous. The safer approach? Maintain a 2 to 3 year cash buffer alongside your income portfolio. This protects you from having to sell shares during downturns and lets you weather the inevitable periods when high-yield ETF distributions shrink. Now let's talk about reinvestment, because this is where the compounding magic happens. If you're still in the accumulation phase and don't need income yet, reinvesting those dividends, even from moderate yield ETFs, can massively accelerate your growth. For example, $100,000 invested in SCHD with a 3.5% yield reinvested over 20 years could grow to over $400,000 at an 8% annual return rate. Compare that to a high-yield ETF with 10% payouts but zero growth. You'd collect income, yes, but your base might stagnate. Let's simulate real-world outcomes. Imagine two investors, both investing $100,000 each into two portfolios, one in QYLD with a 10% yield but 0% price growth, and one in GP with an 8% yield and 4% annual growth. After 10 years, QYLD's total value would still be roughly $100,000. You've collected income but no appreciation. GEPI, on the other hand, would grow to about $148,000, even after accounting for payouts. That's a $48,000 difference, enough to fund an extra year or two of retirement expenses. Another factor often overlooked is tax efficiency. Many high-yield ETFs distribute income that's taxed as ordinary income, not qualified dividends, which can eat up your returns. A 6% qualified yield can actually beat an 8% unqualified one after taxes. Holding high-yield ETFs in tax-advantaged accounts like IRAs or 401ks can help, while keeping growth-focused ETFs in taxable accounts allows you to benefit from lower long-term capital gains rates. But the real challenge is behavioral. High yields feel comforting. They give the illusion of control, money arriving monthly, even in volatile markets. That consistency can make investors ignore the bigger picture. It's why some people hold on to eroding funds for years, telling themselves, at least it's paying me. In reality, that steady drip of income might be slowly draining their wealth. So what are the safer high-yield alternatives? Covered call ETFs can be fine as part of a diversified income strategy, especially funds like JEPI or DIVO that manage volatility carefully. For higher but stable income, look at preferred share ETFs like PFFD or PFXF, which yield around 6% to 7%, but are backed by financial institutions. For those comfortable with risk, BDC ETFs or REIT ETFs can provide 8% plus yields, but it's crucial to choose ones with solid track records and conservative management. And then there's the slow and steady route, dividend growth ETFs like VIG, SCHD, or DGRO. They may not have double-digit yields, but their dividends increase every year. And that's what truly fights inflation and sustains income through market cycles. Let's look at what that means in practice. Imagine two investors. Investor A chooses a 10% yield ETF that pays monthly, but loses 4% in NAV each year. Investor B chooses a 4% yield ETF that grows dividends by 6% annually and appreciates at 7%. After 20 years, Investor A might have enjoyed higher cash flow early on, but their portfolio could be worth half of what it started with. Investor B, on the other hand, could see their portfolio double or triple in value, while their annual income also doubles through compounding dividend growth. That's why the smartest income investors think beyond yield. They focus on total return, the combination of income and appreciation. Because it's the total return that determines how long your wealth lasts, not just how big your next dividend check looks. Risk management should always come first. A rule of thumb: If a fund's yield looks too good to be true, check its 5 or 10-year chart. Has its price stayed stable? Have dividends grown or shrunk? If the distributions have been cut multiple times, that's a red flag. Finally, let's talk about investor mindset. The goal of high-yield investing shouldn't just be about maximizing income. It should be about aligning your portfolio with your goals. If you're nearing retirement and need reliable cash flow, a mix of moderate yield ETFs and dividend growers might suit you. If you're younger, prioritizing reinvestment and growth will give you far more freedom later. The takeaway is simple. Don't chase yield. Understand yield. Because true financial independence isn't built on unsustainable payouts. It's built on balance, consistency, and compounding. At the end of the day, high-yield ETFs can play a role in your strategy, but they're seasoning, not the main course. Think of them as the spice that adds flavor to a diversified portfolio, not the meal itself. The best portfolios blend income, growth, and stability in proportions that fit your risk tolerance and time horizon. So next time you see an ETF flashing a 12% yield, pause. Ask yourself, is this income sustainable, or am I just getting my money back in disguise? Once you start thinking that way, you'll see the investing world very differently and much more clearly. Because smart investors don't just chase returns, they build wealth that lasts.